Hello traders, James Stanley with StoneX and Forex.com. In this video, I wanted to look at one of the more important parts of technical analysis with diagnosing trends. In a prior video, I looked at the two tenets of technical analysis, of which the first is trend analysis, the second is support and resistance. Now, the reason that these are so utterly important, and I think it's also the reason you'll see many experienced traders default to more of a technical lean, is it's the acceptance that you're going to be wrong at times in this field. Trading is one of the few areas of life where failure is practically guaranteed at times. And if you try to run from that, if you try to just constantly outguess the market and you don't look at the strategy element of what it is that you're doing, you are in a very vulnerable position. You're in a very fragile space where just being a little bit more wrong can be a very dangerous thing. And if we're looking at trading from a practical standpoint, I think the most alluring aspect of analysis is that we could put ourselves in positions where we could possibly risk a dollar to try to make two. And that speaks to the premise of asymmetry. And asymmetry is what can allow a trader to be in a position where they really only need to be right, maybe 35 or 40% of the time, to look at a net profit. And if they are in a good space where they're right 50% of the time, then even better. They can look at a much more handsome net profit. But it really comes down to controlling losses, cutting losers, letting winners run. And to do this, it really dials back to analysis and finding positions, finding ways with which that can be done. The trend is a bias. It's a bias that's displayed in the market. There's often a reason for that bias. If you want to harp on headlines and news flow and get really anxious about what is driving those trends or what could create those trends or what can continue to drive those trends, you're welcome to do so. But to the analyst, to the chart analyst, it's much easier to just take a step back, look at the trend, and then say, well, that's an uptrend. I want to buy support. As soon as I have support, I'm going to risk a dollar to try to make two so that the trend continues. Maybe I'll make 3, 4, or 5. That's the entire premise behind this, and it all goes back to the acceptance that failure at times is unavoidable. So without further ado, let's get to the chart. Let's start looking at how we could diagnose trends and getting deeper into this concept of probabilistic trading. So first and foremost, I want to start off with a quick chart on gold. And I think this illustrates why trends are important, because if we look at this over the last 2 years, sure, there have been a couple of pockets where bears or sellers might have been able to do okay. But by and large, if you have to flip a coin with heads long, tails short, to decide your direction, you want that to come up on heads more often than not when you have a trend of this magnitude. Now, it's not to say that just spray and pray and buying every high or buying every breakout is going to work, but that's where the strategy element comes in. That's where the buying support area or aspect comes in, or waiting for a bullish formation like a bull pennant to build comes in. I mean, this is a weekly chart. These are 3 very clear formations that have built over this 2-year trend, and I mean, these are longer term formations. That channel, that consolidation took about 4 months. This one took about 2 months. But I mean, you could see it very clearly breaking out on the weekly, and that just continues into a near parabolic like run, very similar to what happened here just about a year after that first one. And here we are approaching the 5K handle. But this is why trends are impactful, and this is why you want to diagnose trend so that you could try to get on the side of that trend so that the bias does continue, then great. And if it doesn't, then you mitigate the damage from when you're wrong because you're not expecting to be perfect. But stocks, I think, is another good example. Let's take a quick look here. Like, same deal. If you had to flip a coin to decide a directional stance in the S&P 500 over the past like 18 to 20 years, you want that coming up heads more than tails to bias towards the long side of this. Again, there are pockets where sellers might have done okay, but by and large, this chart is up and to the right. That's the direction you want to look for this to come into play. So, again, maybe not just chasing every fresh breakout or every fresh high and waiting for sequencing or a bullish reversal formation or an oversold RSI illustration to lead you into the idea or the way of getting long, something along those lines. But trend analysis is what gets you back there. Now, I want to use Eurodollar here because Eurodollar as a currency pair isn't going to be as, I think, as directional. And the reason for that is there are two sides to this pair. This is both the euro and the US dollar, whereas gold or SPX, those are largely binary markets. You could buy it or you could sell it. There's a reason that those biases have remained very aggressively bullish over the past couple of years, 18 years, and for stocks at least. Whereas with the currency pair, in my belief, it has a tendency to mean revert. And the reason for that is because the foundational importance of the asset class. If we see a prolonged run, such as we did in 2021 to 2022, where the US dollar gets significantly stronger against the euro, that has ramifications. That's going to produce a higher level of inflation in Europe on the basis of a weaker euro. And that's automatically going to compel the European Central Bank to hike rates more, which is why we then saw a reversal as the ECB got more aggressive with rate hikes in Q4 of 2023. 2022 into 2023. And then lo and behold, we range mean revert for an extended period of time. So in learning trends, this is not the perfect environment or perfect market to do it, which is why I wanted to use it in this example, because using something like gold or SPX would just be too clear of a hindsight bias in doing so. Now, in Eurodollar, there's, again, two ways that trends could be diagnosed. I think the simplest is with an indicator. The one that I use that I'm going to share with you in this video is price action. But I want to address this before we go further. What's the best time frame to use? That's a really common question that comes up. And I'm going to give you two answers based on how you want to implement strategy. If you're a swing trader, if you're looking to essentially work with major market swings, so you're triggering off like the 4-hour chart or the daily chart, I think the weekly chart is the best time frame to use to analyze trends. The reason for that is it's going to be a little slower with trend transitions. There's only 52 bars every year versus, the full gamut of daily bars. But I think this is a cleaner manifestation for what it is that I do with swing trading. If you're an intraday trader and you're triggering positions off of like the hourly or below, I think the daily chart is going to be more optimal. Now, when we get into this dynamic, there's the concept of sample sizing. And the smaller the sample size, the noisier the data set. And it pertains here as well. And there's a really good example right in here. If we look at what happened like last July, initially that pullback is a test of a higher low, and it's a clean one too. You could see where we had higher low support come in right at prior resistance, right in there. But that bounce goes up to a lower high and then a lower low. It looks like we have the start of a bearish trend right in here. And that even holds when we get the pullback from that lower low, because we have like resistance building right in here. But notice bulls just chew through that. Fresh higher high and then another higher high, and it throws that whole bearish signaling out of whack. If we look at this from the weekly chart, it doesn't really happen, right? As a matter of fact, this looks clean to the upside because that prior point of resistance comes into support for like multiple weeks and just simply leads to a fresh higher high. And so the time frame to use, the optimal time frame to use for trend diagnostics, it's going to be based on your outlook, your time frame, your strategy. And if you're a swing trader, like I said, the weekly. If you're an intraday trader, I think the daily is optimal. But let's go to that indicator method. So I know a lot of traders, especially experienced traders. I mean, one of the first indicators you learn is the moving average, because it's simple. It makes a lot of sense. It's simply the last 200 periods closing prices divided by 200, and the value of which is plotted directly on the chart. It's just a lagging moving average. And I think that technical analysis in general will often get a bad rap because of indicators, because they don't work. Well, an indicator, it doesn't really have a job. It's just a way of looking at something. And a simple moving average is, again, it's stupid in that it just spits out the average of the last 200 periods closing prices. But there can be elements where I think it's beneficial. But first and foremost, the main drawback to one of these is the lag. By the time we get the bullish break, that upside trend has already been going for a little while. Like we had a resistance point right there, right around the 105 and a quarter handle. and then it breaks right there. So the bullish trend is already in order at that point, but the 200-day moving average doesn't register it for another almost 200 pips. And then by the time we do get above, the move's already somewhat stretched. And then you'll see on some of these prior instances, again, just dirty signals. It breaks below, doesn't stay below. Now we ultimately end up lower, but it's imperfect. And I think this is, again, what gives technical analysis a bad rap with a lot of traders. They'll see a lot of these messy instances. It doesn't always work, and it's pointless. And why am I even looking at this? Well, again, the whole point of this is probabilities, not prediction. And the past is not always going to predict the future. You have to know that. But nothing else will predict the future either. The past is simply one of the better guides that we have for creating if-then statements. But what I think is notable here is the way that sometimes that moving average will show up as a clean spot of support. Or maybe a clean spot of resistance. Again, not perfect. It's not all the time. But this is simply a lagging indicator. Now, to address the lag, sometimes traders will get a lot shorter term. But now, again, we're dealing with the sample sizing issue, because when we go down to 100 periods, it's going to be noisier, it's going to be messier. There will be more signals, but there's also going to be less consistency in those signals. But again, kind of the same thing. You're going to get some of these instances where it shows us a really clean spot of support or resistance. Again, something that we're going to look at in a future video about support or resistance in trading directional trends. Could take this down even more. Like sometimes traders will go down to like a 50. The same thing. It's going to be more signals, noisier signals, less consistency behind each, but you'll still find some elements of support or resistance. Now, all that being said, and let's go back to the 200. All that being said, it is still usable. And again, the point isn't for perfection, because perfection is impossible. If you're seeking perfection, you're going to be disappointed and you're never going to find it. But when we get something like this, when we get a 200 DMA break and the trend is now biased to the upside, we can look for other ways to try to get long. So let's go back to that instance. As a matter of fact, I'm going to fix this just to the daily chart. So that way, when we go down to a 4-hour, it's still going to show the daily reading. But what we're looking for is that crossover that happened last March. And then we could look for ways to get long, because at that point, the bias is long. And what we're looking for is some type of way, some type of excuse to establish topside long exposure. And as you'll see right in here, that is very resembling. It's close to a Morningstar formation. That's a hammer. Ideally, with a Morningstar, you got a doji as the second candle, but very similar to a Morningstar formation where you have a bullish reversal and that pops up to a fresh higher high. The pullback of which holds a higher low and then a higher high and then a higher low, and then it explodes. And a strong topside run. And then look at that support build right there, right around 109 flat, right in here. And then again, same thing, fresh higher high, breakout, and then a hold of higher low support, breakout. A clean run after that 200 DMA. So, I mean, again, just because it doesn't look pretty from the daily, it doesn't look like every trend transition takes place in a perfect manner. It can still be very usable for directional biasing in a trading strategy. But it is lagging, and that's inevitable because of the mathematics behind it. You're using the last 200 periods, it's going to lag. And then if you try to get it shorter, you're going to have more noise, just sampling. What I think is a better way of going about it is using price action, because it's dynamic. Now, it is going to introduce a degree of subjectivity, which is, I think, what scares off many new traders. But the simple logic behind price action is lower lows and lower highs make for a downtrend, higher highs and higher lows make for an uptrend. And there will be periods where it gets a little bit messy, where you get digestion, very similar to what we've had over the past 6 months in Eurodollar. But even then, it's addressable. But the simple logic, the simple algorithm is higher highs and higher lows are what make uptrends. And let's just start back here in this period. We can call this a downtrend, as we had a breach of that swing low right in here. And then that leads to a lower high and then a lower low. Okay, so at that point, we're going to call that a downtrend because we had sequencing of lower lows and lower highs. And then that begins to reverse, that begins to breach right in here. So that was the lower high. And that gets broken right in there with a fresh higher high. I'm going to mark that blue to denote the higher high. Now, once we have the higher high, we could also say that was the prior higher low because that was the higher low that printed just before the higher high came into play. Okay. The pullback of which then holds another higher low right in here. Now, the point of doing this on the weekly is if I'm looking at this on a 4-hour or a daily, I'm looking for ways to bid support after we have that fresh bullish trend coming into play. And then if we break below that higher low, then it's negated, then it's invalidated, then the trend might be reversing. I don't want to be hanging around to see how wrong I might have been. But we get the higher high, then the higher low, and then the fresh higher high right in here. Fresh higher low right in here. And then it's slight, but you'll see we got another higher low or a higher high right there. Right? So you could see a trend transition taking place in there. Let's even mark the prior one. Right? That's the lower high. Into the lower low, lower high. Now that higher low doesn't confirm until we got the higher high, but once we do, that's the higher low. Then the second higher low, then the breakout right there. What negates all of this, what throws us all upside down, is what happens right here. That big bearish engulf, notice it takes out the prior higher low. Okay? Now, at that point, we're like right at the end of Q3, open to Q4 of 2024. At that point, we got an opening door to a fresh trend in Eurodollar. And this is where I want to start looking for ways to get short. Again, I'm using a smaller time frame, a tighter time frame. I'm going down to try to find ways to sell resistance. I want to sell resistance so that I could look to risk $1 to try to make 2. And again, that breakdown. So I mean, we can even look at this in a more granular fashion. That was around the time that it happened. That was the weekly bar that it happened. But it was this break right here of that higher low support that brings that to fruition. Okay, I'm going to clean this chart up so that we can then analyze this on the 4-hour chart. So we get this fresh lower low. That's the break right there. That's what brings on the bearish trend. Now, I would like to think that I'd be able to fade that first pullback, but the reality is I don't know that there was any point of resistance there. It's very close to the 110 handle. 110 is one of those very common psychological levels that could come in as a support or resistance, but it didn't quite hit there. So I'm going to assume that I did not get that lower high. But what brings us to life is we break down to a fresh lower low. You'll see this on the 4-hour chart. And this point of support comes right in as resistance. Look at how cleanly that played. Right at that point, we have the bearish bias on the weekly because we have the breakdown of the lower low. Now on the 4-hour, I'm able to catch this lower high on a pullback to resistance at prior support. And then it goes down to another breakdown, another fresh lower low. And it just continues to sell off. And again, at that point, when we got the break, I'm looking for ways to get short. I'm looking for ways to sell resistance. And there's a variety of things that I could do. I could use prior swing levels. I could use Fibonacci levels. I could use psychological levels. But the whole point there is I don't want to get caught by saying, well, that's an uptrend. No, that's a pullback and a broader downtrend because the trend is being diagnosed on the weekly. We already have the breakdown of that move right in there. And that little pullback is not something I want to get reversed on. All right, I want to look for ways to fade the pullback to go in the trend side direction. So I'm looking for ways to get resistance. That's the whole point of trend biasing because I know the direction I want it. I just don't know exactly how I'm going to get short until I get the resistance hit, until I get the show of sellers at that point of resistance. And then when I get the breakdown, then life becomes a little bit more simple. And it could be something like, again, a bearish reversal formation. It could be resistance at prior support. Be any number of ways to justify that short side positioning. But once the direction is decided, it then becomes simple. Sell resistance, buy support, and downtrends, buy support, sell resistance, and uptrends. Wash, rinse, repeat. Getting back to the weekly and looking at this trend diagnostics, because that sell-off did not last forever. We get the fresh bearish trend starting right there, and then notice is lower lows and lower highs, and lower lows and lower highs, and lower lows and lower highs. Now, again, I don't know, we won't know that trend is reversing at that point. Okay, all that we know is the sellers defended the pullback. But we have the lower low right in here. We have the lower high right in here. And sellers are still in control at that point. But what begins to shift is right in here, when bears are unable to break down and retest that lower low. Now, at that point, again, we don't know that it's reversing. All that we know is that sellers failed to push to a fresh low. The sequencing that was so easy to drive back here is no longer taking place. That could be the first step towards reversal, but we can't confirm that until we get the higher high right in here. Once we get the higher high, then we have a higher low confirmed. Now we got the breakout. And now we want to be biasing this on the long side. Now, the whole reason that this is important is because of what's playing through right now, where buyers have been unable to break up to that fresh high. So we might be nearing a point where reversal is opening up in Eurodollar. We don't know yet, but we're going to get feedback on one direction or the other before too long. And then that's going to inform us of what direction we could then take Eurodollar for a directional bias. But once that bullish bias comes in, again, the prerogative is looking for ways to get long, looking for ways to buy support, looking for ways to risk $1 to try to make 2. The trend gets bullish on this weekly bar right here, early March of 2025. And let's go down to a short term, like a 4-hour chart, and see what we can dice up as far as the topside strategy is concerned. All right, again, same kind of thing. I'm looking for ways to bid support, ways to get long, almost like excuses to get long, because I know the directional bias that I want. I just don't know exactly how I'm going to be able to get long until the setup shows up. And again, usually like a short term, like a 4-hour or a daily chart is what's going to open that for me. There's a Morningstar-like formation right in there. Again, it's almost close to a doji, but I get that 3-bar sequence that indicates bottoming, sell-off, indecision, reversal, and that leads into a higher high and higher low sequencing. And then you look at the way those higher highs and higher lows played. Comes out somewhat clean, right? Where we got resistance, breakout, support, breakout. And then once we get that breakout, notice where that comes in, right at the 109 handle, right? And if I'm looking at that on a 4-hour chart, I'm seeing that consistent display of support right around 109. Simply look for continuation. And then we get the same thing up here, right around 112.5. Same deal. Buyers defend support. We rally up to a fresh higher high. Try to make the prospect of analysis a little bit simpler. Because really, at the end of the day, nothing is predictive. The whole, I think, goal of analysis should be to try to put ourselves in positions where we could try to risk $1 in effort of making 2. There's still no guarantees. But that's what I think the most attractive part of this approach is. It's accepting that there's no guarantees. It's accepting that there's no crystal balls. It's accepting of the fact that you're going to be wrong at times. And so when you're wrong, be wrong really small. And when you're right, try to put yourself in a position where you can feast on that trend for a little while and look for 2 to 3 times that risk outlay. And when you're using multiple time frame analysis, you will get a lot of these setups, a lot of these areas where you'll find very clear support showing at prior resistance, keeping the door open for bullish breakouts, bullish continuation. And when you're right, you can be really right. When you're wrong, be wrong small. But that's what I have in this video. Like I said, in future videos, we'll look at support and resistance. We'll look at ways of getting much more granular with strategy and ways at incorporating some of these support and resistance levels with trend diagnostics. But that's what I have for this week. Thank you for your time. And as always, happy trading.